Hello and welcome to this video on consumption. In this video, we're going to look at the main determinants of consumer spending or consumption. We're going to look at the wealth effect and then the relationship between consumption and saving. So to get us started, what affects the level of spending in your household? Maybe pause the video now and have a think, what would be the things that would affect the amount people spend in your household at home? Well, one thing you might have said is earnings from people's work. Perhaps you might have talked about inheritance. Perhaps you might have talked about how much savings people have or how much they are saving. Perhaps you might have talked about their access to credit cards or their access to loans. Consumer spending is what we mean by consumption. So it's spending on consumer goods and services. And the main sources of consumer incomes are wages, savings, investments, pensions in retirement, and also benefits may be paid out by the government. In 2012, UK consumer spending was £927 billion out of a total GDP of 1.5 trillion, 1,504 billion. So consumption is the biggest component of UK aggregate demand. It normally takes up around 60-65% of GDP. So to understand consumption, we need to understand the marginal propensity to consume. So linking back to this topic, and that is how much extra is spent on goods and services following an increase in income. So for example, if incomes rise by 10,000, consumption increases by 6,000. We're talking about people in the economy here having a marginal propensity to consume of 0.6. So what further factors affect consumer spending? Well, perhaps the level of real disposable income, so incomes adjusted for inflation and after direct taxes and benefits, that's real disposable income. Perhaps employment and job security, maybe household wealth would affect the level of consumer spending. Expectations and sentiment, so what people are expecting or the future economic outlook. And then finally, maybe market interest rates, because remembering interest rates are the reward for saving and also the cost of borrowing. Consumer confidence is an important part of consumption, and some factors that might affect consumer confidence are again economic growth, the level of household debt, perhaps unemployment and job security, the value of a house. And we can often learn about the level of consumer confidence in an economy by looking at consumer confidence surveys, in which organizations measure a range of consumer attitudes, including their expectations of the general economic situation and their own financial position, and whether they expect things to be improving or deteriorating in the economy. So consumer confidence is an important part of determining the level of consumption. And tied with that is the wealth effect. And this is a psychological phenomenon that causes people to spend more as the value of their assets rises. The idea is that when consumers' homes or investment portfolios, and by that we mean sort of shares that they might own in businesses, when those things, their assets increase in value, they feel more financially secure, and so they increase their spending. So often it's observable in an economy that house price rises because a house is normally a person's main asset in terms of value. As that becomes worth more, people increase their level of consumer spending. So we've looked at the determinants of consumer spending, we've looked at the wealth effect, we're now going to look at the relationship between consumption and saving. So saving is household disposable income that is not spent. So a flip side of thinking about this, it is that saving is deferred spending. Spending I'm not doing now, but will defer to do it in the future. And there are many ways in which money can be saved. So bank and building society accounts, saving into a pension, buying shares in companies and saving in the stock market would even be considered by many a form of saving. The savings ratio is the percentage of disposable income that people save rather than spend. So for example, if a person has an annual income of £25,000 after tax and benefits, and saved £2,500, then the savings ratio is 10%. A high savings ratio lowers consumption and aggregate demand. Let's have a look at the level of UK household saving. So a recent survey suggests that 19% of households have no savings at all. 55% have between £1 and £50,000 in savings. 12% have over £50,000 in savings, and 15% just don't know. Around a fifth of households in the UK have no savings at all. Indeed, many are dependent on short-term credit to get them by from month to month. What might affect the saving ratio? Well, the real interest rate compared to the rate of inflation. So if the interest rate is outstripping the rate of inflation, there's a positive real interest rate, then there might be an incentive to increase savings. Price expectations. If consumers expect prices to fall, deflation, they may choose to save now and buy later. The availability of credit, so consumer borrowing, which is really dissaving, taking out loans, will affect the savings ratio. Unemployment, job security. When unemployment is rising, many people save more as a precaution. Consumer confidence. When consumer confidence is strong, people are maybe more willing to borrow and save less. Tax on savings. So a lot of accounts, you have to pay tax on savings unless it's an ISA. So the interest in many types of savings is taxed. And if that tax rises, people will save less. One thing to consider is maybe trust in savings institutions. So whether people believe that if they save with a particular bank, they're actually going to get their money back. So not that long ago in this country, there were queues outside Northern Rock when people lost faith in that institution to look after their savings. And lastly, the need to pay back debt. So people may be struggling to save, or if they're having to pay off debts. Why is savings important to understand within the economy? Well, from a business perspective, corporate savings, so businesses' savings, can provide a cushion during a recession. Business savings can be used as finance for takeovers, or savings can be used for future capital investment, large-scale investment projects. Why is saving important to understand? Well, it's very important in the way in which banks work. So banks take savings, deposits or savings from individuals, and then they lend that money out to other individuals. So without savings, banks can't really function. For consumers, savings can smooth consumption during tough times. If you're in between jobs, you might use your previous savings so you can continue to consume. They allow people to reduce their debts and pay off their debts with savings. They're also a key source of retirement income and take some of the burden off the state if people have been saving adequately. So it's important we understand saving and its impact on the economy. So in this video, we've looked at the main determinants of consumer spending. We've looked at the wealth effect and the relationship between consumption and saving. That's it. Thank you very much.